All right. It is time for Mike's Market Update, July version, late in July, probably going to be coming to you early August, but hey, better late than never. Got some good stuff to cover. We are going to, it's kind of a series of inflation talks, so going on the macro stuff. So for that reason, we'll recap what I talked about last month because it really sets up kind of what's going on this month and tease us up for kind of understanding how institutional money can affect our market. And if there's one thing that has really empowered me as a real estate investor in understanding economics is understanding how does institutional money move, because that ripple effects through everything in our economy. And so we'll get into that today. So getting in onto the June recap, we talked about inflation in detail, and we talked about the difference between expansionary monetary policy, so the creation of more money, and the difference of that between transitory inflation or supply and demand issues. And I read a great article last week that said the Feds have used the word transitory inflation no less than 151 times this year. So obviously it's big on their mind. That's really what we're seeing when it comes to supply chain issues and why prices are increasing. We did deep dive on that and looked at some commodity prices last month. So good recap there. I highly recommend reading that if you really don't understand how inflation works. Looking behind the headlines, we did that last year. Why the Fed will stay dovish. So the market recording last week was right prior to the Fed explaining their meeting minutes. So having their comments come out after their meeting in June. And they did stay dovish. I said that they would stay dovish. However, if you look at it at a scale, dovish on one end and hawkish on the other, remember, hawkish means we have a strong economy. That means they're going to be less accommodative. Dovish means we have a weak economy. A weak economy means they're going to be more accommodative. And the talk since mid-February and on has been inflation, inflation, inflation. We're getting these ridiculously high inflation readings because of the COVID cliff. When you compare March, April, May, and June of 2021 to March, April, May, and June of 2020, inflation looks really, really high because you're comparing a booming economy in relativity compared to a sluggish or a pulled back economy in 2020. So those numbers aren't real. And so they did get less dovish, meaning the dot plot, they came out, their comments said their dot plot on interest rates, there's actually some of the Fed leaders that are expecting their increase of the Fed funds rate to come sooner rather than later. So instead of at the end of 2023 or 2024, they're now talking about potentially raising rates at some point twice. Now, kind of the consensus is twice in 2023. And so the market reacted to that. So we're going to talk about why the market reacted, how the market reacted, and how that makes sense and how we can relate that to making sense in the real estate world. Employment and inflation mandates. We talked about that. So why was the Fed not acting? Why is the Fed not acting? Why is the Fed not acting when we have inflation? We have inflation, we have inflation. And the reason being is they have two mandates. They're really concerned about the employment market. And so that's why they're staying dovish. That's why they're staying accommodative, is because their bigger concern is employment, not inflation. They look at inflation as transitory, not monetary policy creation. But the big concern is employment. And we've got some GDP predictions, a really good slide that shows they were right to be concerned because we haven't had solid employment numbers. When you look at jobless claims, new jobless claims and hiring, the numbers have been slowly getting worse. As the Delta variant and COVID comes out, that is affecting our economy again. And so they were pretty smart in saying, hey, we're waiting to see this through. Yes, we see inflation. Yes, we truly understand the deep dive inflation, but we're not going to overreact to inflation. We really want to focus on the economy and the jobs market as our main focus. Inventory deep dive, we talked about that. Inventory has been increasing, whether we believe that or not, but so is demand, and that's why supply levels are lower. And then we got into appreciation rates at the micro level in Portland. Ridiculously high appreciation rates from when you look at the average sales price versus the median sales price. We talked about buyer fatigue. Buyer fatigue is real. You combine buyer fatigue with a normal summer slowdown. People always think summer's the hottest real estate market. It's not. The spring is. People relax in the summer. They go on vacation. They aren't overly going out to look at homes. They want to enjoy life. And so when you combine buyer fatigue with the summer slowdown, now it really feels like the market's changing significantly. And it is changing. Market conditions are changing. but it's not something to be truly, truly concerned about. We'll dive into that this week as well. What we'll cover today, macro, reaction to the Fed's June meeting, got some great slides to show on that. Q2 GDP predictions and what to expect there. Excellent slide. We're going to dig into that. The Fed and their mortgage-backed security purchasing. When will they taper? That's a big thing. When I look at the real estate market, to me, that's the biggest thing. Not interest rates, not what they're going to do with interest rates, because interest rates, in my opinion, right now are more tied to inflation and bond traders' expectations of inflation, because the mortgage interest rates really correlate to the 10-year Treasury note. And the 10-year Treasury note is not necessarily affected by the Fed. When the Fed increases their rates, that affects the entire yield curve. But the bond traders' reaction and they're moving in and out of the 10-year Treasury note, that affects mortgage rates more than anything. And then when will they taper? So the mortgage-backed security purchasing, they're purchasing 40 billion. Yeah, it's 80 billion in bonds, treasuries, 40 billion a month in mortgage-backed securities. That may be reversed, but that's the big thing, because that's putting more money into the mortgage market. So when we talk about monetary creation and inflation, putting more and consistently putting more money into the mortgage market, right? So investors fund mortgages, they package them together, and then they sell them to the Fed, which creates more money, lets them fund more mortgages. And so adding that liquidity to the mortgage market adds money to the real estate market. And so I do feel like we're seeing monetary creation increase our sales prices or create inflation in the mortgage market, which then is the real estate market. So when they taper is really the kind of the biggest thing that I see that will potentially affect our market conditions going forward. So we'll talk about that. Market value, a conversation I've had a lot this past month is, what is market value? So we're actually going to look at the definition of that and kind of my thoughts around that. And then we're going to do a year in COVID. We got some custom slides for Portland locally in the year in COVID recap. So let's talk about macro inflation. So here's Friday, June 18th. So the Fed comments came out right in the middle of June. It was 14th, 15th, sometime around there. And what happened? The market crashed. It didn't crash, it came down. And so those were the headlines immediately, is the market went down because of the Fed's comments. And there's two things to note here. Why did the market go down when the Fed's comments came out? And so A, why did it go down? And then B, why did it come back up? So they went down because the Fed reacted. They said, hey, they talked about the dot plot on interest rates when they're going to start raising their interest rates, which affects the yield curve. They talked about, very dovish, we're not going to do anything till the end of 2023, to slightly less dovish, meaning, hey, we're probably going to see the dot plot change. And so when you look at the leaders of the Fed, some of them think that they should start raising interest rates sooner in 2023. And so then the market reacts to that, saying, oh, the Fed will actually do something about inflation, right? So if you're concerned about inflation and you're an institutional investor, what do? You pull your money out of the 10-year security, the 10-year Treasury, because that's a really safe asset with really low yield, and you don't want to be a lender. So if you invest in Treasuries, you're lending money to the government. You don't want to be a lender in an inflationary market. You want to be a borrower. So what do? They pull their money out of the lending and then they move into assets like the stock market, gold, crypto, those types of things. And so when the Fed says, hey, we can do something about inflation, we have the tools to do something about inflation, we will do something about inflation, immediately bond traders, institutional money say, we've been moving out of the bonds and we're going to move into assets. And now the Fed reacts and says, we're going to do something about that. Now it's time to pull money out of assets and then get back into treasuries. Okay. And so that's the back and forth that the Fed and institutional money does. And so that's what happened. We saw a decline. So here's our decline after the Fed's comments, the decline. So we go into treasuries, we pull out of assets, but then what does that create? That creates a buying the dip opportunity. And this is what we're going to see when we have so much cash in the marketplace sitting on the sidelines. I've been saying this for years. One reason why I'm not really concerned of crashes is because we have historical amounts of cash sitting on the sidelines. And what are they waiting for? They're waiting for a really good investment opportunity. What's a really good investment opportunity? A dip, right? So they can then go and buy. And so we have this artificial floor, and we have it in almost all of our markets right now because of the amount of cash on the sidelines waiting for investments. And so that's what we've seen in almost every asset class, the fast trading asset classes, I should say. We see this quick dip and then a rebound. We saw it again here recently in June, and those are for other reasons that we'll get into. But you're going to see that in all these asset classes. There's the Dow. Here's gold. Here's the Fed's comments. Boom, immediately gold. So what are you doing? So gold is that you invest in gold in an inflationary market. So the Fed says, you know what? We're going to take care of inflation. We see it. We're not going to let it get out of control. Boom, pull out of gold and get into treasuries, right? So that you see that, and then you see the dip, buying on the dip, and gold goes back up. 10-year treasury yield. So here we are, the 7th, the 14th. So here are the Fed comments right around here, and then you can see that downward trend, right? So these are yields. Okay, so yields are the opposite. That means prices are going up, right? So now institutional money is pulling out of the stock market. They're pulling out of crypto. I didn't have any good Bitcoin slides, so I didn't put any in here, but we had a crash in Bitcoin, crash in gold. What did they do? They sold those assets and they moved into the treasuries. So the price of treasuries go up, the yields go down, and that's what we've seen. Yields go down, the lowest they've been, they got to the lowest point that they were since February. And then what does that do? That then correlates to 30-year interest rates. So here's our comments, and then here's our 30. So we saw our 30-year interest rates go down. And so that's how institutional money reacts to the Fed and what they're doing, and how that then affects our real estate market. So what does this do? This props up the real estate market. So when the Fed comes out and says, hey, we're still going to flood money into the we're still going to buy mortgage-backed securities. We will raise interest rates if we have to, sooner than we think we've been saying, if we need to, if inflation continues to rear its ugly head. Then that movement in institutional money then puts downward pressure on interest rates, and then downward pressure on interest rates then makes real estate cheaper, which then can put upward pressure on real estate. So that's kind of what we're seeing, and it's really important to understand how that institutional money works, because it does correlate to real estate. So those are the thoughts I wanted to get in here. Q2 GDP production. So again, let's look at our time frame here, right? So this is a running timeline that the Atlanta Fed does of, hey, this is our Atlanta Fed, and this is our estimate of what Q2 GDP is going to be. And so you can see early on, they expected it to be really, really, really high, right? This is really kind of as the Delta variant was coming out, the discussion of the Delta variant was coming out, and then what happened? Their projections slid significantly. Now, this is a really high projection. We're looking at 8%. Everything I've read is around 9% GDP for Q2. That's significant growth. But remember, we're comparing Q2 GDP in 2021 to Q2 GDP in 2020. Well, what happened in 2020 Q2? That's when the market shut down. That's when our economy shut down. So again, normally around 2%, 8 or 9% is ridiculously high because of that gap, that COVID cliff that we're comparing it to. But the important thing to see here is, as the Delta variant started taking shape, as our new jobless claims, our job numbers weren't looking as steady, then their predictions start lowering. Okay, and so this is why the Fed stays dovish, because they're more concerned about employment right now than they are about inflation. They have the tools to fight inflation. How can they fight inflation? They can taper. They can stop buying assets. They can stop buying securities, treasury notes, and they can stop buying mortgage-backed securities. So they have the tool to pare that back. They also have the interest rate tool, so they can change the yield curve across all the different type of asset classes. And so they have the tools to fight inflation. They're not concerned about fighting inflation. They're concerned about employment. And as the employment numbers got worse, then the Q2 GDP projections lowered. So that's kind of my thought process of how does institutional money work. And again, our new mandate on the Fed, that they're going to be reactive, not proactive. They're going to let stuff play out, and they're not going to overreact early. They're going to wait until they see actual data before they start making decisions. All right, so this article did come out today on the Bloomberg. So the Fed mortgage-backed security buying high on agendas as officials begin taper. So they've got a meeting this month to talk about GDP. And the expectation is, well, there's already some of the Fed leaders are talking hawkish. They want to start tapering back mortgage-backed buying securities. But the majority of the Fed leaders are still dovish, and they don't want to taper back mortgage-backed securities. So in this article, they actually talked about, you probably won't even see any discussion about paring back mortgage-backed securities when their meeting minutes come out. Okay, so they probably won't actually, even though they're talking about it, they may not be on the notes. right now, we're probably not going to see any paring back of the mortgage-backed security buying until 2023. Maybe this year they start talking about it. They've got their Jackson Hole meeting in August, so maybe in December they start talking about it. But don't expect the Fed to pull any money out of the mortgage market or stop feeding the mortgage market anytime soon. Maybe in 2022, definitely in 2023. And that's something that I will continue to monitor because, like I said, that's the most important thing when it comes to trying to predict our next 6, 12, and 18 months from a real estate market. So when you're thinking short-term projects, development projects, flips, land development, new construction, you really need to be paying attention to what's going on 6, 12, and 18 months down the road. When you're buying hold investor, it's less important. You're looking at the rental market. You're looking at, do you have sustainable cash flow? Are your debt levels okay? Do you have equity in your property? So it's a different outlook. But for our development company side, this is what I really focus on in the real estate market. Definition of market value. So just look at the bold here. So each party, sellers and buyers, so the buyer and seller each acting prudently and knowledgeably, and then assuming the price is not affected by undue stimulus. Can anyone say that this is our real estate market in the past 6 or 7 months? Is everyone acting prudently and knowledgeably? When I think knowledgeably, what is market value? Do we even know what market value is, right? Prudently, no inspections, appraisal gap waivers, that's not prudent and it's not knowledgeable. And then the reason they're doing that is because they are affected by undue stimulus. What is that undue stimulus? Not enough inventory given the amount of buyers out there, ridiculously low interest rates, a significant amount of money flowing into the mortgage market, which then makes money easier to come by, complete opposite of 2008, 2009. 2008, 2009, you could get a loan to save your life. Now you can go get a loan, you can get really good interest rates, you've got great down payment programs. It's completely opposite. And even though that it's a very accommodative thing, that you don't think of accommodative as undue stimulus, but that accommodation in the mortgage market creates undue stimulus when buyers are fighting against each other. And so when you look at the definition of market value, and then here's the qualifying things, buyers typically motivated. Can you say buyers are typically motivated right now, or they have been in the past 6 to 7 months? I think that's tough to argue. Well informed, well advised. Wow, if your broker's telling you to not do an inspection and to waive your appraisal, that's not well informed. That's not well advised. And is that acting in what you believe is in your best interest? If you're going to buy something now, own it for 7, 10 years, yeah, I can see overpaying. I get that. It's your dream home. It's Oz. Move into it. I'm okay with that. But just understand that, what are you buying into, and are you going to be there in the longevity? And is that really your best interest? If you're buying something now and you're going to move in the next 3 years, that's probably not in your best interest because it's probably not a wise financial decision. A reasonable time allowed for exposure to the open market. Look at our days on market, historically low days on market. When you don't have exposure in the market, we're actually in the new condo play that we're doing on the development side, we're actually buying listed properties again. I hate the bidding wars. And with one of the realtors that's sending us a ton of inventory to look at every single day, it's like, nah, just let it sit on the market, let it sit on the market, let it sit in the market. Because I want it to get some market exposure. I wanted the sellers to see that, hey, it's a little overpriced. And so I want that exposure to the market, because if you don't get that exposure to the market and you come to the table with all this aggressiveness, that handicaps your negotiations and your ability to buy at a point that makes sense. And these other ones don't really affect our discussion today. So price is different. So price is not market value, not necessarily market value. And I'm not saying that stuff doesn't sell at market value. There's times where price truly reflects market value, but price is not inherently market value. Price is what's reported. So list price is what it's listed as. Sold price is what it's sold for. So it does not always equate market value. And so here's a thought process conversation I've been having when it comes to price. The reported sold price is the winner, right? So if you think about 8 out of 10 sales are bidding wars, well, what's reported? The price that's reported is the person that wins that bidding war, okay? And they typically win via terms or amount of money. So typically it's the highest price. Not always, not all sellers want the highest price, but in this market, time over time again, it's the highest price that is ending up winning. And that's because that's what the retail world pushes. Brokers think price is the main agenda. That's why we say in the off-market world, you want to talk to the sellers where price isn't their biggest desire. Sometimes they want speed. Sometimes they want slowness, like we're doing a 1031 now, where we're not going to close that thing till next year because they want time to go find something. And so they're giving us a good price and our willingness to be patient because we have exposure of risk. When we're being patient for them and interest rates are this low, we're exposed to risk via higher interest rates, higher cost of funds when we ultimately do close. So there's people in the world that really push, the retail world pushes for a higher price, but that's not always the thing. But again, when we look at market value, where do appraisers go to get their information? They go to the multiple listing. They go to the retail world because that's where you have educated buyers, educated sellers, working in their own best interest, yada, yada, yada. So typically it's the highest price. So in 2021, the majority sales seen bidding wars. Most of those winners are the highest price. And then here's the key. Many of the bidding wars have an outlier price. We see this time and time again in the stuff that we sell, and grouped pricing. So let's just use some examples. So say you see a sale that's recorded, the price that's recorded is 600,000. They may have one person offering 600,000. They may have 10 people offering 550,000. Okay, what's market value in that scenario? If you think one party does not create a market, it's the actions of multiple parties that create a market. Well, in that scenario, that fake scenario, 550 is the market value, but the recorded price is $600,000. And so we're going to see that, and the market needs to reflect to that. So can we really say that the reported sales price reflects market value? Some instances, sure we can, but some we can't. And so the market is going to have to deal with this: brokers, buyers, sellers, appraisers. So this is what I'm expecting. Expect list price ratios to drop in the next few months. Okay, we've seen ridiculously high list price ratios, well above 100%. That's not going to be the case, right? Because if we're using comps, now we have comps, we have reported sales prices that show an exacerbated market. And so if the mindset of brokers continues, oh, it's just going to get bid up, we've got, right, that's been the trend. Comps support X, we're going to list at Y, it sells above Y. Okay. Now that those sales above Y are the comps, if you continue that mindset that says, well, now we've got Y, we're going to list at Z and expect it to sell above Z, that potentially won't happen. And so we're going to see this change in the market, this calibration of the market, so to speak. And so I do expect list price ratios to drop because retail brokers push price. Retail brokers, how do I say this in a nice way? Retail brokers, for the most part, don't really understand what market values are. They just don't think in those terms because they don't have risk. When you represent buyers and sellers, you have no money in the game. You don't have skin in the game. You don't have any risk. And so it doesn't matter as much to you. And so that's what I see when I talk to people. They don't really understand what market value is. And so I do expect this to happen. I don't think that's a bad thing. I don't think lowering list price ratio is a bad thing unless buyers start getting emotional. Because remember, markets are based off of emotions. The stock market goes like this because A, it's emotional, and B, you can trade within minutes, right? Real estate market does much, much slower dips and ups and downs because it moves so slowly. So because it moves slowly, I don't really think this is going to be an issue. But if an overwhelming amount of the buyers out there start getting emotional, they start thinking that there's blood in the water, this could be cause for concern down the road. Don't think it really is, but it potentially could be. Let's get into our local real estate market here. Again, geez Louise, look at this. Boom, 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 right around 1 month, 100 months. So we jump back up a little bit. You look at the end of month inventory, this is creeping up. This is a very, very good thing, right? We need a little bit more inventory so we can have higher supply levels, because remember, supply levels are a measure of competition. It's not a measure of inventory, it's a measure of competition. So we need to see higher inventory to reduce the competition, which means supply levels go up, which means buyers can be more patient, buyers can make better decisions. So this is a good thing that we're seeing inventory tick up. And if you look at our COVID cliff, you can kind of see that curve, right? There's our curve, right? If you look at 2020 to 2021, we have this kind of curve here. So this is a very, very good thing when we actually see sellers come to the market. So we look at new listings. We talked about that. Sellers coming to the market, we've kind of slowed down. We're getting not as many sellers coming to the market compared to historics, okay? And why do we have ridiculously, and so let's look at that in detail. So this is a custom slide we created when you look at July to March. And then next month, I'll include April, May, June, and July. I want to get that data before I show that. But look at the new listings. It's a lot higher than 2020, because we're part of that is here. We're trying to figure out, you can see these lower numbers here. That's early on when the economy is starting to come back and sellers are feeling out the market. So it's high compared to 2020, but it's really, it's not. It's actually lower than 2019. 2020 here, these dates are split, the years are split, but it's when you look at it, it's less than a couple years prior. So even though we're seeing sellers come back to the market, they're not coming back to the market like they have historically. On the flip side, on the demand side, so here's kind of a headline pull from RMLS: decrease. So pending sales decrease, leading indicator. Okay, so we're going to put that into perspective. This could be a cause for concern when you see this verbiage. Oh my gosh, pending sales are down year over year. Pending sales are down month to month. Let's put it into perspective, because I don't think it's something we should be concerned about. So pending sales, look, boom, 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 ridiculously high historically amount of pending sales. We had the drop at the COVID, and then in 2021 again. And then we have this little drop. But look at that drop. That is the historic norm from May to June. And I talked about that early on in this video. It's the summer slowdown, okay? The highest peak in pending sales, right? Demand ramping up, demand ramping down, taking advantage of your summertime. So this is just common. I'm not concerned about demand pulling back, okay? It feels different because it's not so exacerbably, ridiculously overheated that it feels different, but historically it's not different. And then here's that same graph for pending sales. Now this is different, right? Significantly higher, heads and shoulders higher on the demand side. That's why supply levels are so down. It's not because sellers aren't coming to the market. They are kind of in the volume that they historically do. It's because demand is ridiculously high. Leading indicators here for pending sales. Closed sales. We're not seeing any slowdown in the closed sales side, right? And so even though pending sales are slow down a little bit, closing sales are a lagging indicator, and they're still looking really, really strong. Now, I do expect this to kind of curve off a little bit, because that's what it should happen this time of year. So we'll probably see that going forward. And then that same graph, again, head and shoulders difference, right? So demand is super, super strong. So what does that go back to? That goes back to institutional money, right? Mortgage-backed security purchasing, institutional money looking for safety, moving into the 10-year treasury notes, lowering yield, lowering mortgage rates on the 30-year mortgage. That then props up the real estate market, right? So more effective purchasing power. When you look at supply and demand, you can look at, hey, this is the amount of new listings, this is the amount of inventory on the supply side, this is the amount of pending sales, this is the amount of closed sales on the demand side. But when you dig deeper, the most important factor when it comes to demand is effective purchasing power. And because of what's happening at the institutional world, at the Fed level, affecting institutional money, effective purchasing power is the highest we've ever seen it. And so that's why we're getting what we're getting out of the market right now. Days on market looks like they may potentially be tapering off. We'll see. And then the overall stats. This is stupid. Year to date price appreciation, average sales price, median sales price, 20%. That's stupid. Absolutely ridiculous. It is not sustainable. When you're penciling out your flips, be aware of that. Don't think that a price is going to appreciate. If you've got, not great comps and you're thinking, oh, I'm positive we can sell it for 550, but we may sell it for 600. Don't run your numbers at 600. Run your numbers at 550. So that way, if the market does go back to normal, you're not going to get screwed at the end. So there's my advice on that scenario. So that's it. Thanks for watching. If you have any questions, don't hesitate to reach out. Happy to answer any questions. We can do videos. I can do emails, text, chat, whatever. Give me a call. Let's chat real estate. I love to do that. Happy investing. Keep kicking butt out there, and we'll see y'all next month. And it should be a shorter time frame, because we'll do it at a normal time frame next month. All right, everybody. Adios.